What's going on, guys, and welcome back to another video. Now, considering that Discovery have actually put in a solid performance in the stock market for once this week, I thought that it made sense to go over why we're seeing the gain and then also very briefly touch on why I'm so bullish on the stock, which is primarily relating to the valuation, but we'll get into all of that very shortly. So we can see here that Discovery has risen by almost 15% in the last week, and that is following them getting past another regulatory hurdle regarding their merger with Warner Media. So we can see from this Seeking Alpha article that Discovery has won approval from the European Commission to take sole control of Warner Media from AT&T in the two companies' mega deal set to clear this summer. So I don't really think that I need to touch too much on this merger. I think most people are aware of it by now. If you're not, you can go and watch my previous video. But in effect, Discovery and Warner Media are coming together to create one giant streaming service. And whilst we're not exactly expecting any stumbling blocks with regards to regulatory hurdles, you never know, and therefore when you do get some good news, you expect the share price to move accordingly. When I say that this new company is going to be a company that is competing with the likes of Netflix, Amazon Prime and Disney Plus, well, I really mean that, right? Because we're going to have over 200,000 hours of content, which as far as I'm aware is actually better than all of those three others. Not combined, but all of the three individually. And therefore, this is a massive streaming service. And if this really does kick off like we're expecting it to, well, then obviously there's massive potential there. Now, I know that you guys like your data and figures. So to back that up, we've got here the number of content hours available on selected subscription video on demand platforms in the United Kingdom. Now, I appreciate that it is only UK, but that's because I couldn't find the same data for worldwide. With that being said, right, there's going to be a lot of crossover between UK, for example, US and other regions as well. And therefore, this should still provide us with a reasonable basis. So you can see here that on Amazon Prime, they've got 41,000 hours of content for the UK. Netflix have 38,000 hours of content. Discovery at the moment is 12,000 hours of content, or Discovery Plus. The new media company is set to have over 200,000 hours of content. So this company is going to be huge. But I really don't want to spend too much time addressing the qualitative aspects of the bull thesis in this video, because I've already addressed that in a previous video. So let's just dive straight into the valuation, which I believe presents a fantastic opportunity from an investment perspective. So this valuation is really quite simple and it's really quite high level. The reasons for that is because we don't have all that much information, but we can only work with the information that we have. At the moment, as at the end of 2021, HBO Max had 69 million subscribers, Discovery Plus had 20 million subscribers, and it is believed by management that there's around 10 million sort of crossover there, right? So 10 million people are subscribed to both of these. Therefore, when you merge the companies together, you're going to lose, those individual numbers. As a result of that, you've got total subscribers at the end of 2021 of around 79 million users. And once again, just to back up where I'm getting that information from, the Discovery numbers are taken from the Q3 Discovery reports. And we can see here that they ended Q3 with 20 million direct-to-consumer subscribers, which was an increase, by the way, of 3 million subscribers since the end of Q2. So that's not an increase of 3 million from the prior year, that's an increase of 3 million on the prior quarter. That's phenomenal growth. And then similarly for Warner Media, we can see here that as of September 30th, 2021, the Warner Media business had approximately 69.4 million HBO Max and HBO subscribers globally. Now, David Zaslav, the man that is going to be the CEO of the new company, actually believes that they can get to 400 million subscribers at some point in the future. He doesn't specify when, but his target, his end goal, is 400 million subscribers. And you can see that quote here where he says it could ultimately reach 2, 3, or even 400 million homes worldwide. Now, in my personal valuation, I think that 400 million is too high. If you look at, for example, Netflix, they seem to have peaked out at around 200 million subscribers. They're still growing, but they're growing very slowly. Amazon Prime is somewhere, I think they're around 175 million subscribers, and Disney Plus is around 115 million subscribers. I think that it's probably, and I believe that all three of those will continue to grow, but their levels of growth are obviously slowing down at this point, right? I believe personally that Discovery Plus, the new company, can actually reach 200 million subscribers by 2031. And that's what I've incorporated into my model. Now, as a viewer of my previous video rightfully pointed out, the chances are is actually that a lot of the growth will be front loaded. So management have actually already come out and said that by 2022, or the end of 2022, they're expecting the new company to have 100 million subscribers. And then I'm expecting that to grow by 10 million per year through to 2027, which is a compounded annual growth rate of 11.3% on the 2021 figures. I'm then expecting that growth to slow down to 7.5% per year, which then gets us to 200 million subscribers overall. Now, my valuation or my price target is based on 2027 results, which is a compounded annual growth rate up to that point of 11.3%. and therefore that is the figure that we're going to be using in our valuation. Now here we have some average enterprise value to EBITDA multiples that are generally applied to companies within this industry. We'll come back onto that very shortly. So in terms of what is the enterprise value of the new company going to be, now this is something that is always changing because of course until the companies merge, the equity values of those companies are constantly changing as well. However, at the current price, right, the current market capitalization of Discovery is $17.8 billion. Now, Discovery is going to make up 29% of the total equity of the new company, and therefore we can assume that the new company has an equity value, and it's not really assuming, it's just a calculation, that at the current price, the new company has an equity value of $61 billion. So just to make that perfectly clear, if this figure here, which is taken directly from the markets, i.e. Discovery's market capitalization, represents 29% of the equity, then this value here is a calculation and therefore represents 100% of the equity value, which is the new company. The net debt of the company is based on $43 billion of debt coming from Warner Media, which has already been confirmed from management, and then around $15 billion of debt coming through Discovery, and then Discovery also have around $3 billion of cash on hand. That therefore gives the new company, Warner Brothers Discovery, an enterprise value of $116 billion. Now, management have come out and said that by the end of 2023, they're expecting to post results of $14 billion in adjusted EBITDA. And we can see that figure is taken just here. I've then projected that figure to grow by 11.3% year over year, which is in line with the subscriber growth. Now, realistically, as subscribers get larger, the EBITDA would actually grow by a greater proportion. And that's because once you've already laid the foundations, your costs won't increase in line with your revenues. Therefore, you get margin expansion. And as a result of that, your EBITDA will actually grow at a higher rate than the 11.3% that we see here. But to remain prudent, I've left that at 11.3% growth. As a result of that, we get an adjusted EBITDA at the end of 2027 of $21.5 billion. I've then applied an enterprise value to EBITDA multiple to that of 12. Now, in my opinion, this is very conservative. And the reason for that is this. When we look at the average multiples that are applied to what their competitors will be, we see a massive discrepancy here, right? So for Netflix's current enterprise value to EBITDA multiple is 38. Disney's is 35. And when we take the average across cable TV, which isn't a fair representation because this is not a cable TV business, hence the lower multiple, software entertainment, normal entertainment, Netflix and Disney, you get an average of 29. I'm applying a multiple of just 12, right? So that is less than half than the average and a third of what Netflix's multiple is. As a result of that, I think that this is very conservative, and it gives me a great deal of comfort that actually there's a lot of value within this transaction. That provides us with a 2027 enterprise value of $257 billion. Now, to arrive at the market capitalization, we of course need to take off the net debt figure. Now, net debt at the moment is around $55 billion. And management have said that their long-term goal, which is sometime after sort of 2024, they're expecting their long-term leverage target to be around 2.5 to 3 times of adjusted EBITDA. So therefore, I have taken what EBITDA is for 2027 and I've multiplied that by 3, again to remain conservative. I could have multiplied it by 2.5, which would have given us a greater valuation. But to remain conservative, I multiplied that by 3. And as a result of that, we get a 2027 market cap of $193 billion. Now, as a Discovery shareholder, you would only, of course, own 29% of that equity, and therefore we need to multiply that by 29%. And that gives us a $56 billion equity in the business, or a compounded annual growth rate over that period of time, which is 6 years, of 21%. Now, that is, far outperforming the S&P 500, or what the S&P 500 is going to perform over these next 6 years in all likelihood. And as a result of that, I think that this is potentially a very, very good investment opportunity if things play out in the way that I think that they will. Of course, they might not necessarily, but I do think that there's a lot of promise there. So then people ask me, okay, so why are you still buying the ticker symbol DISCA rather than buying DISCK, in which you get a little bit of a discount? And the reason for that is because in buying DISCA, even if the deal does fall through, the shares are more liquid, and therefore it makes it easier for me to sell my position. And again, the reason I'm doing that is because even though I don't think that the deal will fall through, even if it does, which would be a sort of a worst case scenario, I actually still like the Discovery business itself. And therefore, I'm not reliant on this business going through, or sorry, the transaction going through in order to make money, in my opinion. And the reason I say that is because within my model, I've got 6% revenue growth for years 1 to 5 and 5% revenue growth for years 6 to 10. Now, remember that this is if the merger does not go through. I've got a gross margin of just 63%, which is the average of the last 5 years. And then I've got operating expenses of 37.5%, which again is the average of sort of these 3 years here, without taking into consideration these extremely low years, which would mean I'm being too bullish on the valuation. And then this slightly higher year for 2021, because they've had some sort of additional expenses relating to the merger. I don't think it would be fair to include that in my forecast going forward. I think that around 37.5% is a fair representation of the kind of operating expenses that this business will incur. When we look at that, we see that profit after tax, or net profit, goes from 1.2 billion in 2021 right the way up to 3 billion in 2031. So it's not a massive amount of growth, but it is going up around 2.5 times, which for this kind of business is not too bad at all. And then on the discounted cash flow, I've used an EBITDA margin of just 32%, despite the fact that the average is actually 38%. And I've used an unlevered free cash flow as a percentage of EBITDA of just 55%, despite the fact that we see averages of 67%. And when we take all of that into consideration, I get a fair value per share of around $30, right? Which is a margin of safety of 12%, which is not too bad for a purchase in which I'm hoping actually that the transaction does go through. This is actually a backup scenario. And for a backup scenario, a margin of safety of 12% doesn't sound all that bad. And then it's a similar story with my 2026 enterprise value to EBITDA price target, where I've actually applied a multiple of just 9, and we get a compounded annual growth rate, or a 2026 price target of around $56, which would be a compounded annual growth rate of 9.7%. Now, would I be happy with 9.7%? Not particularly, but once again, it comes back to the fact that actually this is a backup scenario, or a worst case scenario in terms of the merger not going through. I do think that we will see the merger go through, and actually management seem very confident that it may come before Q2 of 2022, which is sort of the initial date that we were provided with. So we'll wait and see what happens. But going back to the original sort of valuation, I'm expecting, or I'm hoping, I guess, for a 21% compounded annual growth rate over the next 6 years, which would be, which would certainly outperform the market. Anyway, guys, I hope you've enjoyed the video, and until next time, thank you.